Very exciting times across the wealth management space in Asia, massive market, obviously. India, of course, growing, ready for a quantum jump, so to speak. Sunil, if I may start with you. You've been observing the market and, in fact, participating for over 3 decades now. How have you seen the Indian market evolve so far?
Yeah, I think India is getting even excited and very excited day by day. As they say, AI is a moment. Indian economy is a moment for the world at large. It is going to be the world's growth engine. And if you look at India, the key structural changes which actually make India really a talk of the town is Indians have started understanding how to invest their savings. India is a savings economy. India is actually 27-28% of the GDP is the savings. Indians have traditionally been investing into real assets and gold, which has dramatically changed. And that has changed to that extent where Indian individuals, Indian HNIs, ultra HNIs, and Indian diaspora become the largest contingent in the last 5 years in Indian capital market. At ASK, we believe sun, moon, and that we only believe data. So I would like to give data because data doesn't lie. Look at the market. Indian market has moved from 1.2 trillion US dollar to 5 trillion US dollar in the last 10 years time. The resultant output is the mutual fund, which is very retail portfolio, has actually had moved from 120 billion US dollar to 800 billion US dollar, which is like 6x, and it's grown at 20%. Within the mutual fund, if you look at the equities, which has actually moved from 60 billion US dollar to 360 billion US dollar, which is again 6x in the last 10 years time. And the most interesting is the alternative investment fund, the private market, has moved from barely 3 billion US dollar to 160 billion US dollar. This is like a massive private investing growth India has seen. And I think this all indicates that Indian economy and Indian consumer actually have got asset allocation right. And that's where the India story actually has been, is actually doing what it is reflecting into Indian economy, because Indian economy, which is growing at 10-11% nominal GDP growth, 7% real growth, 4% inflation, 10-11% nominal growth, the asset and wealth management industry is actually growing double the size of the nominal GDP growth of the country. So last 10 years actually have been given to the regulators to bring in the regulation which is probably friendlier for investment. It is friendlier to the investors for protection point of view. It is more transparent and disclosure focused, which is the need for any investor, local or global. And I think that shift is structural shift. The last one, the financialization of saving, is what India story is all about. We have a billion customers plus having bank account, and as small as 20-cent transaction without any cost, you can do it from your mobile to other person or other vendor, which actually has changed the whole India's way of transacting with each other, investing with each other. The most important here, and just to give you one more data point, whatever Visa does, the transaction for the year, India's unified payment system does it in 1 month. You can understand the scale of financialization of savings, which means a lot to the India for consumption, for investment, and for lifestyle. That's the change we have seen.
Thank you, Sunil. Gautami, if I could turn to you at this point, indeed massive financialization happening on an interoperable digitization platform. But the Indian market is also very fragmented. You have the main hubs, Delhi, of course, Bombay, but you're seeing massive growth coming from the tier 1, tier 2 cities, the smaller cities, so to speak. You also have a massive pool of HNIs growing there. That's really the biggest growth opportunity in the country. How does a firm really build scale in India to realize the potential of that very fragmented but very large market?
Good morning, everybody. I wanted to tell you first that I represent Kotak Mahindra Bank, which is the third largest private sector bank in India. Otherwise, the context will not be clear. We cater to retail customers, wholesale banking customers, so corporates, and then also to the high net worth, ultra high net worth individual customers. Because we are a banking platform, we are able to cater to the entire length and breadth customers in India. To answer your question, Jeanette, most importantly, we have a branch presence across India because of the banking network, and thus we are able to cater to tier 2 and tier 3, that is the next in level cities in India. But what becomes most important for us is, are we going to be able to build enough branches across the country to be able to reach? The answer probably is no, because you will have a cost implication because of that. So what we have done is for the retail customers, and I'm bringing that point because it becomes relevant here. For the retail customers, we have created technology platforms where an ability to onboard on the banking platform is done digitally, an ability to invest through our technology platform is done digitally. So the involvement of a human element to that extent is reduced, and thus very critical to achieve scale. And scale can only be achieved if you are using technology by your side. So that's our retail strategy. We feel that this segment is going to exponentially grow as well in India, as we heard from Sunil, the kind of numbers that we are looking at. Then you come to the private banking or the UHNI segment that we all deal with. Now this segment again is growing exponentially because of the fact that one, there are a lot of IPOs which are coming up. Second, because there's a lot of sales which are happening of India Inc. And that happens because you have reached immense valuations and you want to cash out. It also happens because of the generational shift which is happening in India and probably in any country. You see the next generation is not necessarily interested in running the businesses which their parents or their grandparents created. And thus you see a lot of sale of businesses which happen, and thus the growth in the wealth segment is again big. For that segment, we are very clear, it's going to be a model which is a combination of tech and human intervention. If I am speaking to our ultra high net worth individuals, he's not going to be extremely happy looking at the reports that we submit on a mobile app. He will need interactions. And this is an assumption or a belief that he will need interactions. We have to go to the levels that AI is going to probably question all our jobs, okay? But having said that, with innovation, with proper products that we kind of curate for these set of clients, by ensuring that we are able to add value by intervention of a human angle in it, we are trying to use both the models, the digital model and the human model, to ensure that we are able to reach the customers at length. The strategy that we have created, Jeanette, at Kotak is we've segmentized our clients. Became very important because each client needs, basis their segments are very different. So today as we speak, we have a professional segment which caters to the professional clients, chartered accountants, lawyers, doctors, which are growing a lot in India. The ultra high net worth individuals segment and the high net worth individual segments. Additionally, we also have a segment which is called the non-resident Indian segment. We see a lot of interest of people who have left India 2 decades back or 3 decades back, living in US, Canada, UAE, Singapore, Hong Kong, who are interested in Indian markets, who understand the Indian markets, who have families and friends in India who made tons of money in the Indian markets. And thus the interest that is there in India is humongous. We know of ASK here who have funds set up outside India to get money into India. We have Kotak funds set out outside India to get money into India. So this segment is again growing. So we are looking at it segment-wise to ensure that we have products which will cater to every segment, and we make a seamless entry into India for NRIs and people in India. We are trying to segment and create niche practices for catering to each segment.
Thank you, Gautami. Divij. Gautami, of course, massive wealth management services with Kotak. You have a very influential advisory service. And you speak to all of the client ranges really that Gautami spoke about, both in India and outside. What are the key questions that your clients are asking you? What are the problems they're trying to solve within the Indian market?
Yes, absolutely. And I think for a context, so I work with a boutique investment advisory firm. So our main client base is in the HNI and the ultra high net worth segment. I predominantly look after the latter as well as family offices. So again, very high touch segment. The landscape that has been very well articulated by Sunil in terms of the macro and the structural changes that you're seeing in India is something that we're facing. And we see a big shift away from, tier 1 cities, the major metros, Delhi, Bombay, as you alluded to, remain extremely important, but there is a big development of wealth that's happening all across the country. Tier 2 cities, tier 3 cities, and for us it's a very exciting opportunity. The questions that we see families coming to us with, irrespective of where they're from, and as you know, within the high net worth and the ultra high net worth segment, there is a commonality in terms of problem statements that they come to us with. The way Indian wealth management has been historically distributed across to clients remains very fragmented. So most clients come to us having multiple wealth managers. And so the first problem that they want to solve for is truly understanding what their overall exposure is, being able to see and manage their risk a little bit better. So even something as simple as help us with our MIS and our consolidated reporting. That's a starting point. Secondly, a lot of the families are also multi-generational. And with that comes very different kind of solutions that you have to kind of solve for. Here we're talking about transference of wealth from one generation to the other. In more established multi-generational business families, you would go so far as helping them in terms of setting up structures for succession planning, estate planning, but then also coming into helping create more of a framework, a governance system, a family governance or a family constitution, so that they have certain rules of engagement in which they can operate on. And these families also, whether it's tier 1, tier 2, you're seeing them also becoming more multi-jurisdictional. You have families where children may go overseas, they stay on, they go to college over there, decide that they want to spend a little bit more time overseas, maybe not necessarily be part of the business. And with that, it leaves for different problems or challenges that need to be solved for the clients, because different jurisdictions come with different regulatory nuances that have to be solved for. Toughest, obviously, is if a client's child goes and settles in the US. The kind of planning that we have to do there is very different. But multi-jurisdictional families in terms of the own family construct, as well as now how families are wanting to also develop global allocations as part of their portfolio. And India has predominantly, we have very strict capital controls, but there are enough solutions that are there that the government has approved, which allow us to have conversations to actually start helping clients also develop overseas allocations. This is part of a portfolio diversification tool. It's a currency diversification, and the global markets play a very important aspect. Further to Gautami's point, we also see a two-way flow. So you have Indian clients who are keen to invest overseas, but one of the reasons we're all over here is there's so much interest from offshore, not only the NRI community, and the Indian diaspora, but also global investors who are looking how to access India, and how to access India in the right way, with the right partner, make sure that governance is there, transparency is there. So we are also seeing a lot of interest inbound as well that we work to solve for. Another problem that families often talk about, the Indian wealth management industry has been predominantly, as I mentioned at the start, distribution-led, which means the solutions that are given to investors across are driven by product commissions. And today, 58% of the wealth management industry is actually through this distribution model, and only 14% is on advisory. If you look at the US is only 2% in terms of distribution and almost 60% in terms of advisory. And there is, over the last 5 to 6 years, I've really seen an increase in terms of financial literacy with the clients that we're speaking to, who are demanding more transparency, who are wanting to get into conversations where they know that there is more of an alignment of interest. And this is also a big shift that we're seeing, especially as you go higher up the client value chain. So in the HNI and the ultra HNI segment, this is something that we're definitely seeing them demand of their service providers. And that's at Waterfield, that's all we've ever done for the last 14 years. We're a pure play advisory firm, and I think that's why we've been able to resonate so well with this particular segment of clients.
Divij, I want to turn to Gautami with something that you alluded to about the government giving opportunities and putting in place structures. There are, of course, capital controls in India in terms of how much families can take outside the country. But there are also opportunities within the country in terms of we have a national infrastructure pipeline with trillions of dollars worth of projects. We have a massive digitization push happening in the country. Prime Minister Modi's goal, of course, is to make the country a developed country by 2047. Gautami, what are you telling your clients? Where are the opportunities existing in this market to really channel wealth in? And at the same time, what are the obstacles that they could face within the Indian landscape?
So quickly, we in Kotak look at the trend which Divij was explaining. We call it Globe to India, where global people are interested in India, and India to Globe. Let's not forget the India to Globe leg, because of capital control regulations, is restricted. So per financial year, an Indian resident can take out only $250,000 US. Is that a big sum of money? Not at all. If you have a listed company promoter in India whose kids are in US and wanting to settle in US, it will take, so after the death of the patriarch, one can take out $1 million US. So if there's 100 million, it will take 100 years for the wealth to go out. So that's the kind of restriction that we have in India. So to answer Jeanette's question, a lot of families are looking at how they can take the wealth outside India, especially because their second generation is outside India, and for diversification. So two-pronged strategies, diversification, at least we tell our clients that 20% of their wealth could be diversified in another currency, and dollar is the currency that we talk about. And second is because the second or the third generation does not want to run the businesses, wants to go out of India, how does this capital go? I think some other countries will have the same problems and the same situations faced by some of you while advising your clients. When it comes to India again, traditionally, it has been equities and debts, and all of us three here will agree on that. But when equity markets are doing very well, alternates come up. Alternates have been the flavor in 2007-8 before the crisis. We, in fact, launched an art fund way back in 2006-7 because you wanted alternative ways to invest. Okay. Were we mature enough in 2006 to understand the art fund? Question mark. But alternates get a space, and so is the case in India now. There's a lot of interest in alternate assets. Now we also see a lot of interest in private credits. So you see a lot of funds which are set up by international managers in India doing private credit business. So that's something which is gaining a lot of traction. You see a lot of real estate play through structures like REITs and InvITs. Okay? You have a lot of private equity and real estate funds again, where you are able to participate in a pre-IPO situation, or again a private credit situation, or an infrastructure fund, or special situations which are sourced by the fund manager in a company, like a demerger, like a merger, like a big acquisition, and you know that the valuations of the company will go up. So you acquire some of these companies in your fund. So you see a lot of growth in all these asset classes. Most importantly, as I was talking about India to globe, and I explained about the restriction which exists, we also have something which is called GIFT City, which has been established under the guidance of Prime Minister Narendra Modi. That GIFT City enables an Indian HNI who has a entity, maybe LLP or a partnership or a company, basically in any form, a business entity. You are entitled to take out 50% of the net worth of that company to be deployed in global funds. That's a huge market which we see, or a huge trend that we see, and we see thus a lot of foreign banks and fund houses wanting to capture this market. We have always seen MNC banks like HSBC, Standard Chartered being in India, and they're increasing their presence now. But we've seen JB and LGT also having private banking presence in India. And that itself shows that the way the landscape is growing, people want to participate in the India growth story. And lastly, one point which Divij mentioned, models like advisory, distribution, where people make, where the wealth manager make commissions are prevalent. But you also see multi-family office models which are coming up, because you need to cater to not just the investment requirements, but the overall holistic requirement of a HNI client, be it succession planning, be it family business succession, be it simple restructuring of their companies, be it philanthropy, be it concierge, be it anything which a HNI or a UHNI family will want to do.
Sunil, we are now down to less than 10 minutes left in the conversation. So I want to ask you about these product ranges that we have. Gautami mentioned alternates is a massively growing space within the Indian market. And of course, ASK, backed by Blackstone, is really big into the alternate space. What kind of product innovation are you really seeing in the Indian market that's an opportunity for clients?
Absolutely. I think at ASK in 2022, when we thought of doing the transaction corporate action with Blackstone, and we realized that diversification of assets of the HNIs, ultra HNIs and family offices is the key. We were more pivoted to the public equity long only investing style, which is the most important style in India, and which generates significant alpha, because India is still an alpha market, though at the same time we can't miss the beta part of the market as well, correct? And the passive and active are the new styles which are going to come in. But when we interacted with Blackstone as a whole, and we realized that Indian HNIs and ultra HNIs are now getting diversification as one of the key theme in their portfolios, we thought of creating an alternate investment vertical. And that vertical primarily focused on private market focused, which is private credit, which is the most important part of the growth driver Indian economy would require, because banks and non-banks have their regulatory constraint in structuring those kind of credit transactions, which probably gives a significant opportunity for the alternate investment funds to do the private credit business. Second part is the real assets business, which is a private equity real estate business, whether it's a high yield credit, whether it's a performing credit, whether it's a private equity. I think all these three, because Indians understand real estate well, and they are in a way over allocated to equities, real estate as asset class, but investment into real estate, where underlying is real estate, understands them the most. So I think that is also one area which is done quite well. We diversified apart from private credit and real assets business to hedge solutions business. And in HNIs and ultra HNIs, to get into a long short absolute return funds, index plus funds, and the market neutral strategies is something which is completely new to the Indian market. The size of that market probably is increasing exponentially, and we clearly thought that that is one area we should get into, and we are seeing the reciprocation happening. So in terms of asset allocation, we need to create product and services which probably our ultra HNIs, HNIs, families are diversifying into, and that's what we did in alternate investment side. Private equity is also another interesting area which we would explore at some point of time, but then you have to choose the path. Either you are early stage, you are mid-market, or you are going to be the M&A or acquisition. I think that space we have yet not explored at ASK, but Blackstone obviously is quite large in M&A space. That actually helps us in diversifying our clients' portfolios.
A lot of innovation clearly happening in India, a lot of asks from the clients for product diversification. Divij, do you think India prices risk adequately? Has the market really been tested amid all of these products and demand coming in?
I think it's a very relevant question, especially when you're seeing the valuations today. And in terms of the risks that India face, I would first start off with a positive, and that even in the current backdrop of geopolitical risk and trade uncertainty, the current growth as well as market momentum remains very strong in India. But I think it's also very important to clarify that resilience does not necessarily mean you're immune. And to this effect, if you look at the construct of even our equity indices, about 16 to 17% of ownership in terms of market cap is still through foreign owners. And if we continue to see, if we see sustained outflows from foreign investors, that has an impact on market sentiment. It has an impact on price action. And even though we have a very robust domestic demand that keeps a lot of liquidity continuously coming into the market, it's something that still can have an impact in terms of what we see in the markets per se. The second point is that today Indian equities still trade at a 20 to 30% premium over the emerging market peers, as well as historical averages. This, on the plus side, is a testament to the perception on the opportunities, the structural opportunities that lie ahead. But there is always that risk also of mean reversion. And that would happen if you have a consistent set of follow-on risks in terms of our growth drivers that we associate. For example, weaker public capital expenditure, lower urban consumption, and you also see, as I mentioned, geopolitical risks, market turmoil. That would lead to a higher chance of mean reversion. And we do see a few risks on the horizon. If global political, geopolitical tensions continue, we have geopolitical tensions that are also a lot closer to home, that one has to also be cognizant of. We are susceptible to a certain extent to commodity price volatility. Rupee depreciation can also have an impact. And these are things that we have to keep in mind, even as portfolio managers, that portfolios have to be almost all weather. You have to also look to bring in proper risk management into the tools. But India is exposed to risk. We are very resilient, but that does not mean we can't be impacted.
Well, Divij, one of the panels this morning was, of course, trading in an environment where there's chaos.
Yeah.
And India, of course, is right at the heart of chaos. Arguably, this is a country that has dealt with chaos through the decades. But in the final closing moments of our panel, I want to ask all three of you a question with the request that we keep it to a succinct one-sentence answer. And the question is this: every day, all of us wake up to a different world. In India, we go to bed. There's always a tweet, a Truth Social post coming out from the US. The world is different when we wake up. So, very succinct answer. 3 years down the line, I'm not going long. I'm not Prime Minister Modi. I'm not President Xi Jinping. I'm going only 3 years. 3 years down the line, when we're having a similar conversation, what kind of Indian market will we be speaking about? Sunil, if I could start with you.
Sure. So, I know that one line I will give you, but I'll borrow 2 lines for that. Financial risk, economic risk, both India stacks up so well, and that is all self-mitigated by virtue of India's own positioning, and I'll not go into details. The geopolitical risk is the only risk which actually currently, so the risk is going to be coming from outside into the Indian market and not really. India is now 4th largest, and here is my prediction for the next 3 years. If we happens to meet after 3 years, India will be decisively a 3rd largest economy in the world. Today we are 4th largest. So in 3 year time, we will surpass Germany's economy as well. Yeah.
Gautami.
So quickly, our brand campaign is a sentence called "Hausla hai to ho jayega." You all will not understand this because it's Hindi, but have the courage to dream big. That's our campaign for the Indians, the aspirational Indians that we are dealing with. And we think, and I believe in what Sunil said, that we should be the 3rd largest growing economy, and the interest will remain there. One small comment, I'm wearing a sari, and on the sari you see cycles. When I come next after 3 years, I'll have an autonomous aircraft, a fighter aircraft, speeding with growth and success.
Divij,
Yeah.
same question to you. No cycles on your suit, unfortunately.
No cycles, unfortunately. Not that you can, not any that you can see anyway. One setup to my point that I want to make is I spent 25 years outside of India, predominantly across Asia and Europe. And for me to move back 3 years ago, it was on the professional aspect where I just see a tremendous opportunity of wealth creation across the country. It's very entrepreneurial. The landscape has already been set in terms of the structural numbers. And our RBI governor has captured a philosophy which I think is the most apt way to finish this off. He said this in DC recently, is India is not an investment destination. We are your partner in prosperity. And that's where I see us continuing to remain in 3 years.